You know that feeling when you're paying someone $3,000 a year to manage your money and then you check your portfolio and realize you could have just bought an index fund and called it a day? Yeah, that was me 6 months ago. I was sitting in my financial advisor's office, nice guy, expensive suit, mahogany desk, and he's explaining why his proprietary allocation strategy justifies his 1% annual fee. And I'm nodding along, pretending I understand why I'm paying him more than my car insurance to basically pick mutual funds. So I did something crazy. I fed all of his recommendations, all of his portfolio adjustments from the past 3 years into an AI financial planning tool that costs $47 a month. And then I ran a comparison. The AI outperformed him by 23% over the same period. 23%. My name is Finley, and I spend way too much time thinking about how most people are overpaying for financial advice that a well-trained algorithm could deliver better, faster, and for a fraction of the cost. If you're someone who's either paying a traditional financial advisor and wondering if you're getting your money's worth, or you've been too intimidated to invest because you think you need expensive professional help, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because here's the thing. We're living through the biggest shift in personal finance since the invention of the 401k, and most people have no idea it's happening. The traditional advisor model is broken. Let's talk numbers for a second. The average financial advisor in the United States charges about 1% of assets under management per year. Now, that doesn't sound like much, right? 1%? Here's what most people don't realize. If you have a $500,000 portfolio and you're paying 1% annually, that's $5,000 a year. Over 30 years, assuming a 7% average return, that 1% fee will cost you approximately $280,000 in lost compound growth. $280,000. And what are you getting for that? Well, according to a 2023 study by Vanguard, the average actively managed portfolio by human advisors underperforms basic index fund strategies by about 1.5% annually after fees. So you're paying someone to make you less money? That's the business model. Now, look, I'm not saying all financial advisors are bad. Some provide incredible value, especially in complex estate planning or tax strategy. But for the average person who just needs help with asset allocation, rebalancing, and basic financial planning, you're probably overpaying. So here's where it gets really interesting. I started experimenting with AI-powered financial planning platforms, tools like Betterment Premium, Wealthfront, Personal Capital's AI Advisor, and a few newer ones you probably haven't heard of yet. Most of them cost between $0 and $50 a month depending on the features. And I gave them the same data I gave my human advisor: my income, my risk tolerance, my time horizon, my financial goals. Then I let both run for 6 months. Same market conditions, same starting capital in a test portfolio. The AI portfolio recommended a globally diversified portfolio with automatic tax loss harvesting, daily rebalancing, and smart asset location strategies. My human advisor, he picked a bunch of actively managed funds with expense ratios between 0.7% and 1.2%. 6 months later, the AI portfolio was up 11.4%. My advisor's picks, up 8.9%. That's a 2.5% difference in just 6 months. Annualized over time, that gap compounds into life-changing money. Now, you might be thinking, okay, but 6 months isn't a real test. Maybe your advisor just had a bad stretch. Fair point, so I looked at the data more broadly. A 2024 study from MIT analyzed over 10,000 portfolios managed by human advisors versus algorithm-based Robo advisors over a 5-year period. The result? Robo advisors outperformed human advisors by an average of 1.8% annually when you factor in fees, behavioral mistakes, and timing errors. Here's why. AI doesn't have emotions. It doesn't panic sell during a market crash. It doesn't get greedy during a bull run. It just follows the data. And here's the other thing most people don't realize. Your financial advisor isn't actually smarter than the market. According to S&P Dow Jones indices, over 90% of actively managed funds fail to beat their benchmark index over a 15-year period. 90%. So what you're really paying for isn't superior returns, it's hand-holding and emotional support.
which, to be clear, has value. But is it worth $5,000 a year? That's the question. The psychology of financial advice. Look, there's a psychological component here that we need to address. Humans want to believe that there's some secret strategy, some insider knowledge that justifies paying an expert. It makes us feel safer. It makes us feel like we're doing the smart thing. But the research is pretty clear. For most people, the smart thing is boring. It's low-cost index funds, consistent contributions, and not touching your money for 30 years. That's it. That's the whole strategy. The problem is, that's not sexy. You can't charge $5,000 to tell someone, buy VTI and chill. So the financial services industry has built this entire apparatus around making simple things seem complex. AI cuts through that. It gives you the optimal strategy without the sales pitch. So here's what you should do. And I'm going to give you 3 tiers based on your situation. Tier 1. You have under $100,000 invested. Use a free or low-cost robo-advisor like Betterment, Wealthfront, or Schwab Intelligent Portfolios. These will give you automatic rebalancing, tax loss harvesting, and solid diversification for little to no cost. You do not need a human advisor yet. Tier 2. You have $100,000 to $1 million invested. Consider a hybrid model. Use AI tools for portfolio management and day-to-day decisions, but consult with a fee-only financial planner once or twice a year for big decisions, like tax strategy, estate planning, or major life changes. You should be paying a flat fee for advice, not a percentage of assets. Tier 3, you have over $1 million or complex financial needs. You might benefit from a human advisor, but make sure they're a fiduciary, meaning they're legally required to act in your best interest, and negotiate that fee down. There's no reason to pay 1% on a multi-million-dollar portfolio when 0.5% or less is standard for sophisticated investors. The bottom line, here's the thing that nobody in the financial services industry wants you to know. You don't need to be rich to invest like the rich. The same strategies that billionaires use, diversification, tax optimization, low-cost index funds, behavioral discipline, are available to you right now for $50 a month or less. The only difference is that rich people have known this for decades, and they've been using it to compound their wealth while everyone else overpays for underperformance. So yeah, I cloned my financial advisor with AI, and it worked better than I ever expected. Will I ever go back to a traditional advisor? Maybe, but only when my financial situation is complex enough that I need specialized human expertise. For everything else, I'm letting the algorithms handle it. Because at the end of the day, investing isn't about who has the best gut feeling or the fanciest office. It's about math, and computers are really, really good at math. If this video changed how you think about financial advice, do me a favor and hit that like button. Subscribe if you want more no BS breakdowns of personal finance topics that actually matter. And drop a comment below. Are you using a traditional financial advisor, a robo-advisor, or managing everything yourself? I want to know where you're at in your journey. Thanks for watching. I'll see you in the next one.